This audio podcast is brought to you by ETFdigest.com. Check out Dave's new book, Create Your Own ETF Hedge Fund, a do-it-yourself ETF strategy for private wealth management. Pre-order today and receive nearly 40% off on Amazon.com. Now here's your host, Dave Fry.
Hi everybody, it's Dave at ETF Digest. I am here with Greg Newton of NakedShorts.com. Greg, how you doing?
Doing great, Dave.
This is a special podcast interview that we're doing with the Emerging Markets Monitor in London. We'll be doing this interview in 3 separate parts. I have a lot of respect for this organization and their views. First will be Terry Alexander, head of country risk, and then we will discuss China risks with Yoel Sano. And the third part will be Emerging Europe with Justin Patry, head of Emerging Europe risk. Terry, welcome to the podcast.
Hi, Dave. Hi, Greg. Thank you very much. It's good to be here again.
Terry, why don't you describe the Emerging Markets Monitor and how people can utilize it?
Sure, Dave. Well, Emerging Markets Monitor is the flagship publication of Business Monitor International, and here we analyze political risk, macroeconomic risk, and financial market risk across global emerging markets. With regards to financial markets, we look at foreign exchange, we look at equity indices, fixed income, interest rates, and commodities. And it's very easy to access our content, our analysis on www.businessmonitor.com. And indeed, we have a free blog site which is called riskwatchdog.com, and all of which contains our leading analysis of the day. Now, today I'm going to give a brief overview of how we stand vis-a-vis the global and US economy. And then, as you said, I'm going to hand over to Yoel, who's head of Asia, and to Justin, who's head of Emerging Europe, for them to give their views on those 2 key regions, because we view those 2 areas as crucial to what's going on at the moment in the global economy. So since we last spoke, Dave, which was quite a while ago now, sometime towards the end of 2008, I believe, our view of the world is basically unchanged. In market terms, we are still very much bearish towards equity markets, and one of the key markets that we look at, or the key charts we look at, if you like, is the Dow-Gold ratio. And this we've been bearish on really since it was trading around the 20 level, pretty much 15 to 18 months ago, and that view kicked off with a bearish view towards the Dow. Views very much evolved of late, and we've become more bullish towards precious metals, both on a technical basis, that's gold and silver, and on a fundamental basis too, in that they are, or we view them very much as safe haven assets at this time of depreciation of equities and depreciation in real estate. So investors looking to buy into tangible safe havens. It was trading at 20. The ratio is now trading just under 8, and we see that going towards 5 over the medium term. Now, that equates, for example, to a gold price of 1,000 and a Dow price of 5,000. Now, what we think is perhaps more likely is that the gold will rally towards 1,200 and the Dow will settle around 6,000. But you can see that means we're pretty bearish the Dow, and because of that, and because of the globalized economy in which we live, that means we're bearish towards emerging market equities too. And we think that the process of deleveraging will very much continue, and this will keep upside pressure on the dollar, which in turn keeps us bearish towards commodities, apart from precious metals, and commodities such as oil, which we see basically drifting lower and really not able to thrive. And yes, that the example would be gold at 1,000, Dow at 5,000, but we think it's possibly more likely that gold will rally to say $1,200 an ounce, and the Dow will settle around the 6,000 level. So because we're so bearish the Dow, and because we live in a globalized economy, we continue to stay bearish towards emerging market equities. And on account of that, we think that the deleveraging process will continue, and this will keep upside pressure on the dollar, which in turn keeps us bearish towards commodities except gold and silver. Looking at currencies, we think that the euro is very much at risk from the crisis in emerging Europe, and that is another factor which will help or assist the dollar remain well bid going forward. So, our market views have very much been reinforced by our bearish macroeconomic outlook. And although in 2008 our growth forecasts for across the various regions that we cover were below consensus, we have made some pretty big downward revisions to growth over the recent months. And that has meant that our forecast for global growth in 2009 is now negative 1.2%. If you bear in mind that the IMF considers that anything below 3% means global recession, you can see that we're pretty bearish. Plus, on top of that, we've pushed back our view of a recovery to sometime in 2010 and probably the second half of 2010. So that means we're looking really at an L-shaped recovery. So the recession is pretty deep, it stays with us for a long time, and the recovery is not that great, and when it does happen, it's not going to happen until well into next year. And the reason for this, primarily, is our view of the US consumer, who is completely, as you know, in hiding. And in fact, this tying in with our view of a drawn-out recession is the fact that we see very much a fundamental change in Western consumer habits. And this stands to reason, right? I mean, the consumer is completely saddled with debt. Their net worth has been decimated via equity prices, via house prices. So why would any consumer want to borrow right now? I don't think it's not really a question of the banks not wanting to lend, although obviously they are going to be more conservative, but it's more a question of nobody really wants to borrow. And that fact is going to see the US current account deficit shrink, we think, to negative 1.9% of GDP by 2011, very much consistent with a US savings ratio of 10% or more. And we haven't seen that type of ratio since the early 1990s, and it could actually go much higher than that. Now, that fact alone, together with the potential we think that taxes may well have to be raised going forward in order to pay for this current remedy, will ensure that developed market growth stays below trend for several years. Now, all of this spells very bad news for emerging markets, and the two regions that we'd like to highlight today are Asia and emerging Europe, and they are both at risk, very much at risk from what's going on in the developed world. Mainly because, or one of the main reasons for that as well, is that the Western banking sectors are so exposed to these areas. I think of all loan growth, of all loans to emerging markets, European banks take up 74% of that figure. So you can see how much Western, or European banks at least, are exposed to emerging markets. But both Asia and Europe are suffering from two different aspects of the global crisis. If you look at Asia, first of all, it's very much linked to the US consumer. Asia, interestingly, its vulnerabilities, if you like, have very much shifted. During the Asia crisis, the region was very much susceptible to capital outflows and to hot money outflows. But by building up its forex reserves and building up current account surpluses, it's now become very vulnerable to global trade, to the US consumer. And of course that has plummeted, global trade has fallen off a cliff, and Asia, which has become like the factory of the world, is at risk of shutting down. So Asia is at risk to the US consumer, whereas Europe is very much exposed to the credit crunch. This is a region that has boomed on highly leveraged foreign borrowing, and now the money that they need to refinance the heavy debt positions is drying up, and this is a pretty big exposure to unsustainable levels of debt to GDP, unsustainable current account deficits, and with most of these countries having pegged currencies. So at this point, I'm going to hand over to Yoel to talk about a little bit more about the risks to Asia before moving over to Justin to talk Europe.